What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Thursday, everybody. Weekend is almost upon us. I hope you're all having a productive week. On Tuesday, Yuhua Population Research, a new think tank established by a group of demographers and economists, published a new report which, among other observations, estimated that China needs to spend at least 5% of its GDP annually over several decades to lower the costs of raising children to the level of developed countries. The report found that in 2019 in China, the average cost of raising a child until the age of 18 was 485,000 RMB, just shy of $77,000 US, 6.9 times China's GDP per capita, much higher than many other countries, including the United States, France, Germany, and Japan. This cost is even higher when compared to household income per capita. More on this shortly. The cost is also about 50% higher in urban areas. The report compared the figures with 13 other countries in Europe, Asia, and America, showing China ranking the second most expensive among all these countries in expenditure of raising a child to the age of 18, just behind South Korea, which itself is experiencing its own acute demographic decline and crisis, and the world's lowest official fertility rate at 0.84. The cost of raising a child to the age of 18 was 3.64 times per capita GDP in Germany, 4.11 times per capita GDP in the US, and 5.25 times per capita GDP in the UK. As I mentioned above, however, per capita GDP may not be the best metric to use when comparing China with developed countries. This is because Chinese household income captures a far lower share of national gross domestic product than developed economies do. In developed countries, the household share of income is normally 65 to 75% plus of GDP, whereas in China it is a very low 40 to 45%. The report concluded that the high cost of raising children is a major factor preventing girls in the country of childbearing age to have a child. In recent years, Beijing officials have finally publicly accepted that China is facing a slow-moving demographic crisis. Official numbers show this, and some critics have argued that the real numbers could be much worse. The report discussed above gives a set of suggestions to raise China's fertility rate, including giving a monthly cash subsidy of 1,000 RMB for each child for couples with 2 children, and 2,000 RMB for each child for couples with 3 and more children until the age of 20. Another suggestion is that income tax and social security payments could be reduced by half or exempted for families with 2 or more children. The report concludes that total costs for these and other measures would be about 5% of GDP. We can see that the report argues for large-scale, expensive, untested fiscal policies to lower the cost of raising a child. Now, putting aside the question of how to pay for this, and whether it's doable, and whether the population would believe that they would enjoy a lot of these privileges from the policy in years to come, if in the event of, for example, the government not being able to afford it anymore. Putting these aside, we should point out that the process of demographic decline is so far in that little can be done at this point to reverse the trend for at least a generation, if not longer. Only moves to mitigate the pain of this decline are viable at this point. A total of 8.14 million marriages were registered in 2020, 1.13 million fewer than in 2019, the 7th consecutive year of decline. The report put China's fertility rate at 1.15, some believe this could be lower. In Shanghai and Beijing, the figures were 0.74 and 0.87 respectively. Even the nationalistic state-run Global Times, writing on the report, admitted, quote, "By 2040, China will face a much worse situation than Japan, with slow economic growth, a soaring aging population, and weaker innovation, if China fails to improve its fertility rate." End quote. Next up, major economic and financial developments in the People's Republic of China. We've been following moves to front-load credit-fueled infrastructure to reduce economic slowdown this year over the last few months. We now have harder data which not only shows that this is happening, but that state-owned enterprises are playing a key role in the rollout, suggesting, as we have suspected for some time, that many projects are not economically viable. So state-owned enterprises are being pushed to build them. According to a tally by the state-run financial outlet Securities Daily, 4 provinces in the country, Anhui, Zhejiang, Guangdong, and Jiangxi, have so far announced investment projects led by local state-owned firms totaling 870 billion RMB, approximately 140 billion US dollars. We'll be unpacking this more later in the week. The China Banking and Insurance Regulatory Commission announced this week that a pilot program to grow the individual private pensions market, which was rolled out last year in 2 provincial level regions, will be expanded to the whole of the country starting at the beginning of March this year, and will allow pension insurance companies to participate for the first time. The so-called Special Commercial Pension Insurance pilot program has been experimented with in the East China province of Zhejiang and the southwestern megacity of Chongqing on the Yangtze for about 9 months now. It allows individuals to set up their own private pension accounts with insurers, which invest the funds on their behalf. They can start taking money out after they turn 60. At the same time, Beijing is also in the process of making national what has so far been a local pension system generally, with attempts to quote-unquote balance surpluses in richer provinces with shortfalls in poorer provinces. An adjustment fund for the Corporate Employees Pension Fund was set up in 2018 to allow the central government to redistribute some money to address these shortfalls and the wealth disparities between provinces. China finance expert at Peking University, Michael Pettis, observed on this today, quote, "I think this makes economic sense and ultimately is part of China's transition towards a much-needed rebalancing of income. It's hard not to notice, however, that this also means the local governments get less funding and less control over the disposition of resources." End quote. According to Chinese financial media outlet Caixin, China is taking a quote-unquote more moderate approach to strengthening management of its mobile payment market in response to complaints that central bank rules announced in October could push operating costs up for small businesses. Quote, "Payment platforms will roll out new merchant barcodes for businesses to receive payments," according to a statement released Tuesday by the Payment and Clearing Association of China, a self-regulatory industry organization supervised by the People's Bank of China. Businesses will be free to choose whether to use the new codes or continue to use their personal codes as before. End quote. Under the original rules released by the People's Bank of China, China's central bank, set to take effect in March of this year, business owners would have been barred from using personal codes for business purposes. The mobile payment market is massive in China, processing trillions of dollars every year, and these rules affect hundreds of thousands, if not millions, of small, medium, and micro-sized businesses. Finally, New Oriental Education and Technology Group Inc., China's largest private tutoring company and a huge player generally in the country, has been one of the most high-profile victims of the private education crackdown last year. On Tuesday, we learned through a Hong Kong exchange filing that the massive private tutoring provider lost an incredible $907 million in the 6 months through November last year after Beijing's regulatory crackdown on the industry. During the 6-month period, its cash reserves eroded by over $1 billion due to operating activities. We remember earlier this year, New Oriental announced that it had laid off 60,000 staff last year and had to pay nearly $3.13 billion in severance packages. This week, share prices for the company are down 92% from 12 months ago. And last up, we continue our daily coverage of the Evergrande Housing Crisis. By the way, guys, if you're enjoying the content, please hit the like button. It's a huge help. And if you're watching for the first time and you enjoy the content, maybe consider subscribing. The list of massive crisis-hit Chinese developers in default continue to grow. Evergrande, Yango, Kaisa, Cynic, Fantasia, Modern Land, and others. Guangzhou RNF Properties Co. and China Aoyuan Group are others which are facing similar liquidity crises and are on the edge of default. As we recently covered, even publicly backed firms like Wanke are in trouble as well. Yet the biggest challenges from the sector are still to come. An estimate by Nomura analysts shows China's developers face repayments of almost $20 billion in dollar-denominated offshore bonds in the first quarter of 2022. That's on top of domestic bonds that they have to pay back. That is almost twice the amount, these are the dollar-denominated bonds, that they faced in the fourth quarter of 2021. And with a collapse in sales, only costly government intervention can save many of these companies. We remember back in December, China's 50 major developers recorded a 25% overall decline in sales volume year on year. Sales were even worse last month, as we remember. A new report by Fitch Ratings, taking the assumption that new home sales declined by 30% across the board this year, forecasts that almost 1/3 of Chinese property developers will face a liquidity crisis this year. Remember too, real estate development in the past has represented 25 to 30% of Chinese GDP. Now, let's move from the forest and look at the trees. The thumbnail of this video says forget Evergrande. Of course, we shouldn't really forget Evergrande. We need to follow Evergrande as well. But there are other developers that we also need to follow very closely too. This week, Shimao Group Holdings Limited still has not been able to reach an agreement to extend repayments on about 6 billion RMB, which is just shy of $950 million of high-yield products with China's largest trust firm. It also missed several trust payments according to CITIC Trust Co. Shimao's dollar bond due in July of this year fell 9.4 cents on the dollar yesterday to 54.9 cents, its largest drop in almost 2 months. Late yesterday, Moody's downgraded the developer by 2 notches to Caa1 due to, quote, heightened liquidity risks over the next 6 to 12 months. End quote. Now, we have been following Shimao for months now. The developer builds residential and commercial properties and is among one of the largest debt issuers in China's real estate sector. Insiders leaked to media last week that it has about 1.3 billion RMB of short-term investments due this month and 4.7 billion RMB maturing between April and August. I believe Shimao, along with Wanke, are both important developers to follow throughout this Evergrande housing crisis. Why? Because Shimao was considered a so-called healthy developer at the beginning of this crisis. When Evergrande first blew up, many in the market saw Evergrande as a bit of a shaky investment, but Shimao was believed to be very healthy. Many players in the market understand this and view Shimao as a decent benchmark for the sector as a whole. Shimao was smashed last month, however, seeing its biggest ever bond price collapse after China Credit Trust Co. said a unit of the developer failed to pay 645 million RMB of a 792 million RMB loan due at the end of December. Another developer that we need to keep an eye on is Zhenrou or Zhengrong in the Chinese properties group. Its bond prices hit distressed asset levels today. We will unpack this developer more tomorrow. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.